Hello and welcome to episode 186 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing, buddy?
Well, I was okay until I just broke my chair, Andy. I'm just looking at it. I'm having to lean forward now. My chair that I've done nearly every podcast in, I've leant back. You remember you were at school and you were told not to swing on your chair?
Yeah.
Well, I do that regularly, and I've gone through the back of it. So if you hear a crash during the podcast, it's me forgetting that there is now no back to my chair. But apart from that, I'm good, Andy. What about you?
Good. I just got visions of, as we do this over Skype, and just got visions of you saying hello and then just seeing feet disappearing up into the air as you topple backwards off the chair. But I tell you what, if that does happen, we'll keep it going. We'll keep it professional, and I'll just narrate what's going on. I'm doing all right. I'm doing okay. Yes. Do you know what? I've had it with the heat. I'm going to be one of those moaning Brits. I'm done with it now. Today, I'm just zapped of energy. I've got nothing. I'm trying to eat lots of fruit, keep my energy up, but I'm doing nothing. I'm not even able to exercise anymore. It's just, I don't know how people deal with it in hot countries. Anyway, enough of the moaning. Yeah, are you okay with it, or are you bored of it now?
I'm a mixture because I'm in the loft at the moment, so I'm starting to sweat, and I've only been doing the podcast for about 2 minutes. I have to keep all the windows shut, you see, and it's like a greenhouse. So I'm not too bad. At night I struggle, but I can't complain because during the week I had a day off, a rare day off for Money to the Masses, and actually I don't sunbathe because I don't really enjoy that, but I did spend some outdoor time I went, it was my wife's birthday and she wanted to go for like a spa break. We had this discounted break. It was quite good. The massage and all that kind of stuff that she went for. I'm not really into that, so I ended up just going for a walk for most of it around the grounds and lost her for about 3 hours. So no, it was quite nice to get out and about. So I'm still enjoying it at the moment, only because I just know how woeful the autumn's probably going to end up being. But yeah.
Do you realise we're 186 episodes in, and all we've got after all this time is talking about the weather? I mean, you'd think that we'd have more.
We're true Brits, aren't we, Andy? We could be complaining about Brexit and all sorts of things, but we are more bothered about the weather.
Well, let's talk about something more interesting for the listeners, at least. What have we got coming up on the pod this week?
One of the things will be very interesting because it was inspired by a listener, Jim, to be precise. Jim on Twitter asked a question regarding investing and about what to do if the market is going to fall 50%, as some of the doom mongers say. So I'm going to cover that in a piece. I'm also going to look at digital assets and home insurance. There was some interesting research came out this week about whether digital assets are actually covered on home insurance or not. And it's a bit of a mixed bag, so it's not an easy answer, but that's quite an interesting piece because I then veer off with some words of advice. And then finally, I talk about the dangers of default funds. So it's wonderful we've got the auto-enrolment world going on and people being more engaged with funding pensions within the workplace. But one of the issues is that people just end up putting money in the default fund. There has to be some form of default out there. So if people don't make a choice, their money goes into something. And it is the danger of just doing that and not engaging with the process, and in particular where your money is invested. So that's the final piece. So where should we start, Andy?
Let's start with Jim and see if we can fix it for Jim. Let's talk about the 50% potential drop in the doom mongers are predicting. What do we got?
Jim's question, I'm paraphrasing because it came in on Twitter, and he asked if the market is about to fall 50%, as some of the experts claim it is about to, then should he be moving his money into cash? He's talking about moving half his money into cash. Or should he be moving into gold instead? Or should he leave it in his Vanguard Life Strategy fund that he's got, which is 80% exposed to equities? Now, Jim is well aware that I'm not going to give him advice about what to do. It's a personal decision. But while we were talking on Twitter, I actually said to him, look, this is going to be a great piece for the podcast. This is a general discussion piece, and I don't mind covering on the podcast. So here we go. Now, it'll boil down to, I'm not going to give direct advice on that, but what I will boil down to are 4 strategies, really, that you have. 4 options, if you believe it. Now, that's if you believe that markets are going to fall 50%. Now, I suppose I should start with our market's going to fall 50%. Now, the answer is I don't know. At some point they will do. Equally, just at some point they will go up 50%. It's just the law of averages. It's what they do. It's a bit like standing on the shore and saying, will you get a massive wave every now and then? These things happen. That's what markets do. They go up and they therefore go down.
50% seems ever so high for a non-expert point of view, just in terms of there being no particular trigger point, it just being a thing that might happen. Is that particularly high? Has there been history of that happening? I mean, obviously there's obviously reasons, but without a sort of dramatic historic event that's happening somewhere like China or Greece.
Yeah, it's a good question actually, because it depends on the asset and it depends on the scenario. Now, it is unusual to get a 40% drop or 50% drop in, let's say, UK equities. Now, I say it's unusual if you're looking at a short space of time, because this is what he's really referring to. Jim's clearly referring to a sudden market crash, not something that plays out over a number of years. Because don't forget, after the dot-com bubble crashed, the markets did fall like that over a period of time. It wasn't overnight, but a lot of damage was done early on, but then the market kept going downwards. So you don't tend to get very swift movements like that. You do get it occasionally. It can sometimes take a period of time to play out. Now, normally when you get something like that in maybe developed markets, it's often some major event like the financial crisis that you were alluding to. And it's unusual just to get a correction of that amount. Now, correction is normally a 10% fall in the stock market from a recent high. Now, you should be getting those typically at least every year. And the fact that we didn't have one for basically a couple of years was incredibly unusual, and we all got a bit, well, we didn't, but generally investors got quite complacent and thought that markets were only ever going to go up. So you do also get the 20%, what they call, they're not corrections, they're actually called bear markets. So when something falls by 20% then from its recent high, then that's a bear market, and they happen periodically as well, not as frequently as the corrections, but they happen. You'd expect them to happen every sort of, like we're talking about a dot-com bubble, which was back in 2000, you would have seen at least a couple of those scenarios since then. The issue is you don't know when they're going to happen, but also in different markets they happen at different times. Now, this year we've had corrections in the UK stock market, was one of the last ones to hit 10%, but US stocks fell more than 10% very quickly. Tech stocks, which were principally in America, fell more so. So even within a market you can get areas that fall more rapidly. But we've seen China fall into a bear market this year, so fall more than 20%. So it won't necessarily be universal, but if you see a universal tumble, it's normally a major event, which you've got what you call a black swan event, which you're never going to likely to know is going to happen until it actually does. So if you're trying to protect against this, the four things you have really to do, the four kind of strategies, is firstly to reduce risk. So what I was just talking about there, if you're in Chinese equities, you want to move down the risk spectrum. So that can be within an asset class. You start moving more towards lower risk equities. That could be something like UK equities or more developed markets, because emerging markets are always more volatile because of the cash inflows and outflows. And as soon as somebody gets spooked and investors get spooked, you'd get a flight to safety, and it normally goes from emerging markets to developed markets, and in particular towards things like US equities. We've seen that relatively recently. You can also move down the risk spectrum in terms of assets, so you can go from equities generally down to, say, something like bonds, towards property and cash, the lower risk stuff. So you can start moving out the high risk assets into the lower risk assets. Now, you could do that ahead of time. Once the fallout is happening, it's a bit like, you can do that, but this is all about what you're going to do beforehand. I'll come on to when everything's falling around you, what is possibly one of the history suggests is the best thing to do. But the other thing you can do is you could just get out now. So you could just go, right, you know what, I'm bailing, I'm taking everything out and going into cash. Now, cash is king in a falling market generally. I mean, some assets do go in the opposite direction, but in a world where you don't know what is going to cause a 50% tumble, then it's going to be, if it's going to be everything, like you said, if it's going to be a real financial crisis, then really cash is one of the only assets that will actually do well. It will actually just preserve your money. It won't necessarily grow much, but it will preserve it. The other thing which you could do is to drip out. Then we talk about dripping in the market. So if you had a lump sum of money and you wanted to go into the market and you're worried that the market might fall, then analysis shows that you, rather than put all your money at once, you put it in over stages, and to take the emotion out, you will decide to put in equal instalments over a period of time. It may be a 12th of the money you want to put into the market each month for a year, and you could do it over whatever period you want. That takes the emotion out, but if the market drops, then you're benefiting from pound cost averaging, so you're picking up more shares for the money you're investing, and so when the market recovers, you'd be in a better position. Equally, when a market's falling, then obviously if you have the benefit of hindsight, being getting all your money out beforehand would be the best thing to do, but you don't have that. So you could drip out. So you start to take some of your money out in stages. So that's a bit like what Jim is saying. He's just going, well, I'm taking half of it out. You could do that. But you could drip some of your money out in instalments, much smaller than 50%. And that could be into cash, so slowly increasing your cash positions. You sometimes see fund managers do this, but they don't do it excessively because they obviously have remits to be invested. If you're invested in a UK equity fund, you're not going to be pretty chuffed if you found out it was mostly in cash. And to be honest with you, they wouldn't be able to do it anyway. But you could drip out rather than into cash. You could obviously, in terms of risk, so you could be, rather than moving all your money down the risk spectrum, you could be moving some of your money out of equities into perhaps safer types of assets, which doesn't have to be cash. It could be bonds, it could be property, it could be absolute return funds. Now, I mention absolute return funds there because generally they're pretty naff. They don't do what they should do. They don't provide an absolute return in all market conditions. That was always going to be something that was difficult to achieve. It's more of a marketing spiel. But when I did some 80/20 investor research recently, I actually did a whole piece on funds for a falling market. And there are, when you do the analysis, there are one or two funds that are effectively shorting the market. So if you were a trader and you were day trading equities, you can short the market if you wanted to. You could basically, it's betting against it. And you can do that via ETFs as well. So even if you prefer funds, you can do it via ETFs. But of course, that's more risky because you're taking a definite bet the market's going down. You're starting to speculate a bit more then because you're not really taking a long-term position of the market's going to go down, because generally over time markets do go up. If you look over 50, 60 years or 10 years, 20 years, the general trend is up, but with these big movements up and down. So you're not going to take a long-term bet that the market is going to fall because you're basically betting that capitalism is going to implode. It doesn't work. So they are more speculating. So there are funds that you can look at. If you want to see that, you can go into 80/20 Investor, do a free trial and see those funds. I'm not going to name them on the podcast. And of course, the other thing is you could do absolutely nothing. You could just ride it out and you could just wait to see what happens. Now, of course, we always hear about the doom-mongers who are always saying that the market's going to fall 50%. I've heard that forever, and every day since the financial crisis, pretty much. And it is, there are so many people sitting on the sideline waiting for that they, even if the market did fall 50% and they decided to go in, they wouldn't go in because they'd be too scared. They're scared already. If the market's falling, they're hardly going to go, right, I'm going to go in now, which is what you really should do. You buy when everyone's fearful. They would still sit on the sidelines. But even if they did, because the market has risen so much in the last 7 to 8 years, then they already would be way behind than if they just been in the market and ridden it out. So the long-term ups and downs of the market are part of the fabric of what makes it is. It's a bit like trying to surf. If there are no waves, you can't do it. So it is part of investing. That's why you need to focus on the long-term trend. Now, often when people say to me, are you worried about the market falling 50%? Well, yeah, I don't want to see things fall 50%. But if you're a long-term investor, if you're investing for 10 years plus, then you are going to see probably the market fall 50%. Then you're going to probably see it recover over a period of time. But you're going to probably see that cycle at least once, if not twice. So, and if you're saving for your retirement, you're going to see it multiple times. So it's not even this one you've got to be worried about. It's going to almost be insignificant. It's going to be the future ones when you're getting near the end of your term to retirement, or your term where you're going to might take your money out of the market. But of course, again, if you're getting nearer that period, you should be reducing risk anyway. So you could do nothing. I mean, I'm of that ilk anyway. That's just my way of investing. I'm a long-term investor. I would stay in the market because I would, in the long run, it would recover, and that's the idea, that you're going to invest over the long term. If in a falling market, though, when you're in a falling market, I'm often asked what's the best thing to do. Now, there is no definitive answer, but again, for 80/20 Investor, I did some research a few years back, And the general trend is that markets tend to rebound relatively quickly after a severe market correction. It's very painful on the way down, and they tend to recover, not fully, but they start to bounce, they start to turn around within a very short space of time, typically within months. And that can be uncomfortable being down there because you don't know when you're at the bottom. But the point is, the best days in the market do tend to happen relatively quickly after the worst days in the market. So if you jump out and try and time the market, you're never going to get it correctly, and you're going to miss out some of the good days as well. So if you endured the bad, then you might miss out on some of the positive when it starts to rebound and people start wading back in. And it was interesting because having a conversation this week with a good friend of mine who happens to be a financial advisor, and we were chatting away about the industry and some of the difficulties and some of the problems with the financial services industry. And one of the things is obviously about people willing to pay for financial advice. And sometimes the best advice is to do nothing. And that's very difficult because people don't want to pay somebody £900, £1,000, where the advice is do nothing. And that might be with a final salary pension, do nothing with it, leave it where it is. And that's uncomfortable. But do you know what? Sometimes the best advice in life is to do nothing. And if somebody gives you that advice, then it's very hard to think that was probably worth paying for. But the truth is, sometimes only with the benefit of hindsight, many years later, will you probably find out that it was. So I'm just throwing that in there. Now, I want to just add on to this Jim's piece about gold and cash. Now, gold is an interesting beast. Now, Warren Buffett once said about gold that you buy it because you're hoping that somebody's going to feel fearful than you at some point in the future, so you can sell it to them. And that's largely because gold is fairly inert. We were talking about it the other week, very briefly, I seem to remember. It doesn't do much. There aren't many uses for it other than jewellery. So it doesn't have a lot of value in its own right as a commodity to be used. So therefore, it's kind of seen as a store of value, basically in times of fear. But I did a lot of analysis of 80/20 Investor years ago, looking historically about how does gold really react in volatile periods, particularly when markets go completely haywire and crash and bounce again, when you have something like Jim is describing. Now, if you put gold in a portfolio, a small amount can reduce the volatility. Now, we're talking about that wild up and down. So that's what you would like to see if the market crashes, is the yours doesn't quite go as badly. But gold isn't a hedge against volatility, because the gold price, go and look at the charts, it's incredibly volatile in its own right. But all that happens is sometimes when the market gets completely fearful, it can go in the opposite direction and actually rise because people want to buy it in panic. I suppose if you think of it in the extreme, if the world goes completely to chaos, you could always go and live in a wood with a piece of gold. I think that's the kind of idea. And gold isn't a great hedge against volatility, but what it does do, to a certain point, it can reduce the maximum fall of your portfolio, so the amount it drops down. But funny enough, if you hold more than about 5% in your portfolio in gold, it starts to actually have a counter effect. It starts to actually increase the frequency of your losses, so the periods where your portfolio will fall, and it starts to reduce the frequency of your gains. So in itself, gold can start to be a slight problem, as it were. It's starting to have the characteristics of it being volatile are starting to take an overriding or a too larger emphasis in your portfolio. So gold is very volatile. The time it does well is a complete crisis. So in answer to Jim's question, if the world goes to complete chaos, then gold will do well then. But that's the period where it does do well. Now, equally other periods, we've had the European Euro crisis, that gold didn't do well. In fact, it did badly. So there's not always rhyme or reason. It doesn't always follow logically that it will do well. So yes, gold, I don't personally buy gold. I think the reason the conventional wisdoms around it are normally almost certainly incorrect, and as the evidence shows when I've done the research, it is. So yes, you could buy gold, you could buy other assets, you could buy assets that move in the opposite direction to the market, but cash is king when it comes to these things. It preserves capital. With all the others, there are investment risk, and if you're worried about risk when the market is imploding, then cash is the place to be. But I'm not advising people necessarily just to cash in their portfolios, but that is a general theme. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. the service provides data-driven fund tables. The data is driven by my own unique 80/20 investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insight, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so digital goods and home insurance. What have we got?
Right, this piece is... I mean, did you even think, Andy, that digital goods are covered on home insurance? Are they? What's your view? So when I say digital goods, I clarify that. I mean things like the photos you've got stored on your computer, or music, or things like that. I mean, did you think your home insurance covered them?
Ah, right. Now, I'm glad you clarified, because I was wondering... Yeah, I was thinking of a different type. Okay, so I'm trying to get my head around what you would be claiming for, what the mental trauma of losing such. Oh no, I suppose to digitally replace your music. Music sometimes costs money, obviously, to digitally download, and if you lose it or if you destroyed within a file.
Yeah, we're only talking about your legally downloaded stuff, not your porn collection or anything like that, because that's gone to the wind if that disappears. We're talking about the stuff that you would actually probably put on an insurance claim.
Yeah, I'd never really thought about it. So let's think about it now. I would say perhaps not. Maybe yeah, just because insurance is a bit of what I seem to be a bit of a fuddy-duddy industry. Maybe it's not caught up. I don't know. You're going to tell me, hopefully.
Well, Andy, you don't know. I didn't particularly know this. And we are in the 67% of people who didn't know this, according to some research that's come out. And now, the research was carried out by Compare the Market. Obviously, they've got a vested interest in anything to do with insurance, and there's always an underlying theme to these things, which is why I always like to steer the topic off what it's supposed to be. But it just highlights some interesting points. Now, they looked at 26 policies that exist out there, like home insurance policies, and they found that 20 of them were unclear about what was covered in terms of digital content, and there were only 5 that specifically mentioned music and videos and photographs, so digital content of any kind. What was more clear is that any that did have any nod to this digital world were much more adamant about what wasn't covered, which doesn't surprise me. But there were things like viruses and malicious software and stuff that was lost on a mobile phone, interestingly. So if you lost your mobile phone, recovering the things that were on there, that wasn't covered under your home insurance. Now, when they looked at the policies, they looked at what payouts would be given to you to be able to make some claim for loss of digital assets of any kind. Given that this is a very vague thing that they're saying comes under this category, I'm not even sure you'd be successful. But generally, it was either unspecified, or the most of them would offer about £1,000. The most actually offered £10,000 one policy. So the point is that go and have a look to see what your home insurance policy states is covered under your policy. Are digital assets of any kind? Is there anything digitally that is covered under your home insurance policy? Now, don't ring them up, whatever you do, because there are numerous tales of people who rang up their insurance company to say, what is covered under my policy? Is my TV covered if it blows up or I break it? Then they end up on basically a kind of naughty list, because if you ring up to... they obviously deem it that if you're high risk if you're checking what is covered on your policy. So I wouldn't ring anybody up, but just have a look out of interest. But one of the things I think is clear is that you don't know whether most policies will be pretty hard, I think, to make a claim, but it's a very good reminder to take certain courses of action. Now, there is a cyber insurance out there, and this is probably why Compare the Market we're interested. You can buy cyber insurance. I wouldn't bother with that. I think these sorts of things are just a money-making enterprise. Somebody out there may want to disagree with me, but prevention is always better than cure, because yes, you may have photos and things lost, or songs lost, or something like that, but the real problem with things that are digitally stolen is the aftermath, and that is if your identity's stolen, or if they take out credit in your name. These are the things that can damage credit reports and actually have a lasting impact, which almost certainly won't be covered on any home insurance policy. So what I really want to do is just to, again, one of those things that people think about is, yeah, do you know what would happen if somebody got hold of my password for my email account? Now, this was a really big one. We did a podcast probably about 2 years ago where I did a real thing on this about your email. And so it's worth reminding people, your email account is the centre of your universe these days. Everything from your banks to your insurances to your whatever, friends, everything goes to this one inbox. And if somebody gets access to that, they can reset anything and lock you out by changing the password, and then can start encroaching on all areas of your life. And now there was a journalist this happened to, and basically somebody blackmailed them, took over their life, locked them out of every aspect of their life, and their money, banks and everything, and wouldn't give their money back unless they paid a ransom. Now that is incredible, but it just shows you the importance of your email account, because you keep your password safe for your bank, but do you keep your password safe for your email? You can't have QWERTY, all these sorts of things, the most common passwords, 1, 2, 3, 4, 5, 6. What you need to do is two-step verification. Now that's where all services have it these days. It could be your email. Another one you need to really think about, I'll come on to, is Apple. If you have an Apple product, Apple ID. Now, two-step verification is whereby when you try and log into something, it will then send you a text message, for example, or make a phone call. It happens on your banking a lot. That's why they enforce it on a lot of online banking. And therefore, if somebody, you can't get access unless they have your phone. And so it's a way of verifying you are who you say you are. But of course, if somebody was trying to get access to your banks or emails and you had this two-step verification on, you will get a message, so you will know that it's occurring and can take precautions. But of course, they can't enter anyway without that code. So I would always say, or if you get off this podcast and get your phone out and enable two-step verification on all your emails. So your email account, do it. It takes seconds to do it, and you can then tell your phone to remember all those passwords. You don't have to keep entering things in, but it stops anybody else hacking into your email. On your Apple ID, the reason I say that is because somebody can get hold of your Apple ID and your password if they manage to crack into it and lock you out of all your Apple devices. So your phone, your MacBook, whatever it is, and it's happened to people and they can't get in there. And then everything's locked down and their phone becomes a brick, but they can't get back into it. So do it on that as well. So it's prevention is better than cure, but it's just a good reminder of these very simple things that I think everybody should just quickly do before they do anything else.
Good stuff. And the last piece this week, which is actually quite timely because I was just flicking through my Facebook feed and someone had posted almost exactly about this subject that we're going to talk about now. So we're particularly talking about pensions and the dangers really of being in the default fund, or what to look out for, certainly.
Yeah, I mean, just as you mentioned social media there, Andy, not to jump back a bit, that's another thing. Two-step verify your social media channels, because then people can't lock you out of your Facebook account and impersonate you. But yeah, default funds. Now, there was some research that went around that had, I think it was Hargreaves who did it, and they were talking about, after looking at 58,000 workplace pensions. So these are individuals that have a workplace pension, and it's the wonderful world now that people are more engaged and actually putting money into their work pension through auto-enrolment. Now, often what happens is you have a choice of funds. Now, sometimes it isn't a very good choice, but they are tending to improve. So you do have a choice of funds. What will often happen, there will be a default fund that's selected by the administrators of some kind who or the advisors or whoever set up the pension scheme. Now, that default fund is often pretty naff, to be honest with you. It's just some very, probably it's a managed fund, and normally badly managed at that, because default funds, the funds that they don't have to try and manage, if that, for want of a better word, to outperform, because there's loads of money going into it. So it's just like having a sort of the most profitable enterprise ever. All this money's pouring into this fund by hook or by crook, whether you lose money or make money for them, because it's just a default. So there's no incentive to actually have to outperform. You'd hope there is an incentive for more other funds, whether passive or actively run. Now, the research showed that people who engaged with their pension and made their own investment choices, on average, made about 4.75% per annum extra return than those who just left it languishing in a default fund. And they base that upon looking at most popular funds people choose and all this sort of stuff. The methodology you could pick holes in. But the point is, which is undeniable, is that if you engage with your pension and you make choices, you can end up getting a better return. Buy and hold inevitably will never work as well as regularly reviewing your pension or ISA. If you regularly review funds and move when it's necessary and when there are better options, you will do better. 80/20 Investor was built on that principle. And we did a load of research about how often you should review your funds, and it should be a minimum once a year. I mean, that would be adequate. And they reckon that even if you don't get this 4.75% extra return, just an extra 1% boost per annum will add an extra £60,000 on a typical pension pot. And I can believe that because I've looked at the numbers that I've crunched myself. And apparently only about 22% of people choose their own funds, and the people most likely to do it are those who are over 40. Now, that's understandable because they're getting more engaged with the fact they're thinking, oh my God, I've not saved anything for a pension, I need to make this money work. And the people who have less than £5,000 of small pots are more likely just to stay in a default fund. Just because you've got a small pot doesn't mean you shouldn't try and make it work harder. And so all this research really taps onto, and again, I'm taking it and really delivering a different message to what they're trying to do. It's about reviewing anything you do, regularly reviewing the portfolio, the asset mix, the funds themselves, because then you can make sure that your portfolio and funds will have a better chance of growing. It's a bit like your car, having an MOT after the first period of time, after 3 years of an MOT, you should do it every year. It's similar to that, and the evidence that I've seen and I've analysed is overwhelming that you're better off reviewing your investments regularly. So engage now is the real fix, and review regularly. And of course, you can always look at something like 80/20 Investor if you want to get an idea of the sort of funds or what you can do to try and help your investments grow.
Good stuff. So if you want to contact Damien, of course you can do so. Twitter is a good place. That's what Jim did, at Money to the Masses with a number 2, and that will get through to Damien. Also, if you want to send an email, it's damien@moneytothemasses.com. And also, if you could please review the podcast. It's what helps us get the podcast out there and gets us up the iTunes lists and everything else. And that's all we ask of you as listeners. We don't charge or anything else like that. So if you do review the podcast, then of course you can get a free book from Damien. There's more details on moneytothemasses.com about that. But someone called Miri0392 very kindly put a review on this week. And she says, very educational. I'm slowly making my way through the Money to the Masses podcast. So I'm only 10 podcasts deep, but I already feel so much more confident about my current investments and investing in the future. I've learned lots of other money saving tips too, and important lessons about mortgages and pensions. Thank you, Damien and Andy. This really is a goldmine for anyone who wants to learn how to manage their finances and or build their wealth. That makes me feel warm and fuzzy. How do you feel about that, Damien? It's a good one, that.
It is a good one. I think it's quite good. It had gold in it. It's sort of a nice circular reference. Right, that's it, Andy. We're done.
Yep, we'd best get off. Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.